Right now, you probably have money sitting in a savings account, and your bank is paying you almost nothing for it. We're talking 0.01% interest per year. On $10,000, that's $1. $1 a year. Meanwhile, inflation is quietly erasing 3 to 4% of your money's value every single year. So while you think your savings are growing, they're actually shrinking. And your bank? Your bank is making hundreds of dollars off your money while you sleep. This isn't bad luck. This is a system that was designed to work exactly this way. And in the next 11 minutes, we're going to show you exactly how it works and what to do instead. Let's start with the most uncomfortable truth in personal finance. Your savings account is not saving you. It's saving the bank. Here's how it actually works. When you deposit money into a bank, you're not storing it there. You're lending it to the bank. That's right. Your deposit is legally a loan from you to them. And in return, the bank pays you interest. That's the deal. The problem is what the bank does with your money next. They take your deposit and lend it out to other customers. Home loans at 6%, car loans at 8%, personal loans at 12%, credit cards at 24%. Your bank is borrowing your money for 0.01% and lending it out for 24%. That spread, that gap, is where the profit lives. This is called fractional reserve banking, and it's completely legal. Banks are only required to keep a fraction of your deposit on hand. The rest, lent out, invested, working for them. A single $10,000 deposit can be used to support over $90,000 in loans. Your $10,000 is not sitting in a vault somewhere waiting for you. It's out there in the economy, generating returns, just not for you. Here's the number that will make you angry. The average American bank earned a return on equity of 12% last year. They're earning 12% on capital that includes your money. You're earning 0.01. The math on that is almost offensive. Now let's talk about inflation, because this is where the real damage happens. Inflation means prices go up. Your money buys less every year. Over the last decade, inflation in the US has averaged about 3.1% annually. So every year, your money needs to grow by at least 3.1% just to stay even. Your savings account is growing at 0.01%. The gap between what you earn and what you need to keep up is nearly 3% a year. On $10,000, that's $300 of purchasing power gone. Every year. Silently, in 10 years, your $10,000 in a traditional savings account has the purchasing power of roughly $7,200. You didn't lose money on paper, but you lost almost $3,000 in real value. The savings account didn't protect your money. It just slowed down how fast you lost it. Let's meet 3 people who learned this the hard way. First, meet Michael. He's 31, works in IT, earns $65,000 a year. Michael is responsible. He saves $500 every month. He keeps it all in his bank's savings account because it feels safe. After 5 years, Michael has saved $30,000, but adjusted for inflation, that $30,000 has the purchasing power of about $26,500. Michael did everything right and still lost $3,500 in real value. His bank, on the other hand, used that $30,000 to generate an estimated $3,600 in interest income over the same period. Michael worked hard to save. The bank worked harder to profit from it. Next, meet Lisa. She's 28, a teacher, same income bracket as Michael. Lisa heard about high-yield savings accounts 2 years ago and made the switch. Her online bank pays 4.5% APY. That's 450 times what Michael's bank pays. Same $500 a month. Same discipline. But over 5 years, Lisa earns over $3,500 in interest, instead of $15. Lisa still isn't beating inflation. But she's not hemorrhaging money either. The difference between Michael and Lisa isn't income, discipline, or intelligence. It's one afternoon of research and one account switch. Now meet David. He's 35, same salary range. David splits his money, 3 months of expenses, in a high-yield savings account as his emergency fund. Everything else goes into a low-cost index fund tracking the S&P 500. Over the last 30 years, the S&P 500 has averaged about 10.2% annually. David's invested savings double roughly every 7 years. Over 20 years, $10,000 in a traditional savings account becomes $10,200. The same $10,000 in an index fund becomes approximately $67,000. 670% more. Same starting amount, same 20 years. The difference between these three people isn't luck, it's where the money sits. So why does almost everyone have a traditional savings account? Because banks are very good at making them feel like the smart, safe choice. They say your money is FDIC insured, up to $250,000. That's true. FDIC protection is real and it matters. But FDIC insurance protects you from bank failure, not from inflation. Your money is perfectly safe from the bank going under. It's just quietly losing value every year instead. They say it's liquid. You can access your money anytime. Also true, but high-yield savings accounts are equally liquid. You can transfer funds in 1 to 2 business days. The liquidity argument doesn't hold up against better alternatives. They say it's simple, no risk, no complexity. And this is the real hook. Banks sell you simplicity and safety. What they don't tell you is that simplicity has a price tag, and you're paying it every year. There's a reason banks market savings accounts as safe havens. Psychologically, watching a number stay flat or grow slowly feels better than watching it fluctuate. Even if the fluctuating account is actually building more wealth over time. Banks know that most people will choose perceived safety over actual returns, and they've built their product offering around that psychological preference. The savings account isn't a bad product by accident. It's a brilliantly designed product that serves the bank's interests while appearing to serve yours. The 0.01% isn't a mistake or an oversight. It's the business model. Let's talk about what actually works. There are 4 tiers. Tier 1, high-yield savings account. For your emergency fund, 3 to 6 months of living expenses, use a high-yield savings account. Online banks like Marcus, Ally, or SoFi currently offer 4 to 5% APY. Same FDIC protection, same liquidity, 45 times more interest. This is the minimum upgrade everyone should make immediately. Tier 2, money market accounts. Similar to high-yield savings, but sometimes with check writing privileges. Rates currently competitive with high-yield savings. Good option if your bank offers it. Tier 3, Treasury bills and I-bonds. US government-backed securities, currently paying 4 to 5%. Slightly less liquid, you lock in for weeks to a year, but zero default risk. Great for money you won't need for 6 to 12 months. Tier 4, index funds. For money you won't need for 5+ years, low-cost index funds historically outperform everything else. Not FDIC insured. Value fluctuates. But over long time horizons, the math is dramatically in your favor. The point isn't to be reckless, it's to match the right tool to the right money. Emergency, fund, high-yield savings. Medium-term goals, T-bills or money market. Long-term wealth building, index funds. Let's put it all together with one final comparison. You have $20,000 to put somewhere for 10 years. Traditional savings account at 0.01%. $20,000 becomes $20,020. High-yield savings at 4.5%. $20,000 becomes $30,900. Index fund at historical average 10%. $20,000 becomes $51,800. Same money, same 10 years, $51,000 versus $20,000. That difference isn't investing skill, it's just knowing where to put your money. You might be wondering, why do people keep their money in these accounts if the alternatives are so much better? 3 reasons. 1. Inertia. The bank account you have is the one you opened years ago. Switching feels like effort. 2. Trust. It's your bank. It feels familiar and safe. 3. Nobody taught you. Schools don't teach this. Banks certainly don't advertise it. The system depends on your inertia, your trust, and your lack of information. You just eliminated reason number 3. Here's exactly what to do this week. Step 1. Open a high-yield savings account. Takes 15 minutes online. Step 2. Keep 3 to 6 months of expenses there as your emergency fund. Step 3. Move everything above that into a brokerage account. Start with a total market index fund. Step 4. Automate monthly contributions so you never have to think about it. Step 5. Check your returns once a year. That's it. This isn't complex. It doesn't require a financial advisor. It just requires understanding that where your money sits determines what it does for you. Your bank is not your financial partner. It's a business. And right now, that business is profiting from your money more than you are. That stops today. If this video helped you see your savings differently, subscribe to Finance Whale. We publish new videos every week on how money actually works, so it can start working for you. Share this with someone who still has all their savings in a traditional bank account.